Good afternoon, everyone. BC Richfield here, coming to you live from London. It's just gone 3 p.m. here, which makes it 2 o'clock UTC, covering for the one and only Crypto Burb today. And so we got a little something different today. So hopefully Julian's going to be able to join us on the stream. He's got some prior commitments, but he's going to try and get to us as quickly as he can. But I want us to take a look at Atom today because he really piqued my interest with some of the information that had been coming out on a fundamental level. So I want to take a brief look at Bitcoin, show you guys what I've been looking at there and kind of targets and bits and pieces, take a quick look at the DXY and traditional markets as well. But I do want to do a little bit of a dive into Atom today and also answer any questions that you guys might have. So before we crack on with that, let's just have a very quick word from our partners.
PrimeXBT is the most powerful trading platform offering immediate access to over 30 assets. Trade cryptocurrencies, Forex, commodities, stock indices, and much more, all from a single Bitcoin settled account. Visit the link below and start trading on PrimeXBT in minutes.
Hi everyone, thanks for joining the stream. Apologies there, you got double ads for the beginning, but never a bad thing with PrimeXBT. I hope everyone's doing well. Do let me know if there's any issues with the sound or with the visuals by dropping that or any other questions and bits and pieces you have in the comments. Like I said, Julian's going to try and finish up and come across and join us. But if he can't, I still wanted to kind of take a little look at Atom. But obviously, if any of you guys have got anything in there as well, then you can come along and let us know. All good? Awesome. Thanks for joining, guys. Really do appreciate it. So I want to start by looking at Atom here. All right. Now, all I've got marked out on here are my key time frame, higher time frame levels. Okay. And for those of you that don't know or maybe haven't seen any of my streams or bits and pieces around the nest, I like taking these higher time frame levels and then splitting these with a midline to make them into ranges. Now, ranges are something that very much speak to me in terms of how they trade. And the way that I trade them is I'm looking for what happens when we reach the extremities, so the range lows and the range highs. And for me, I'm looking for deviations or fake outs above, whether we close back in the range and then we look for our entry triggers to trade lower, or if we do get the deviation, close back in and trade higher, or if we close above, then we expect expansion to the upside. So I was having a chat with Julian recently with some input that he's got in terms of fundamental news. And he said that there's some very interesting stuff coming up with Atom. Now, as a technical trader, I love hearing about all the fundamental stuff, but that's not my area of specialty. So if Julian does manage to make it on and join us, then I'm going to pass that side over to him. But for me, I really want to look at the technicals. And something that's caught my interest at the moment is the fact that we're kind of coming back above and reclaiming this key level here, all right, which is around about 8.87. So now that we've done that, the question is this a deviation above this level? And by that, I mean, have we come out? Is price now going to come back down, close below, in which case we would look to target the midline first, and then beyond the midline, we'd be looking to target the range lows, okay? So this is obviously a very high time frame view here on the daily. So how can we kind of get a lower time frame concept? We want to keep our high time frame levels, but how would we look to trade this? So for me, to keep this nice and clean, I'm going to turn these off for a second. And I'm going to show you how I would look at this in terms of developing a shorter time frame range. Now, I like trading inside bar patterns. For me, an inside bar is a good representation of when the market is starting to compress. And from there, we can then look for where the market plans to expand, okay? Now, if we don't have an inside bar pattern, so for those of you that might not be aware of an inside bar pattern, we would be looking at something like this, okay? That's when we've got a candle whereby the following candle, this one here, closes within the range of this first candle. That then becomes an inside bar pattern, all right? This candle here becomes the mother bar, and this becomes the inside bar. Now, typically with these type of patterns, what we're expecting is price to either run, deviate. If it closes back within, then we target the far side of the range, which would be down here. If, however, price closes and holds above, then we expect expansion. Where do we target? We typically target liquidity, all right, which in this instance would be this here. And I'd be looking at this as the down candle. Sorry, it's the last up candle before price moved lower. All right. So keeping it in line with basic order block theory. And that's because we would expect there to be some kind of liquidity here. And then as we would with any support or resistance level, what we're waiting for here is for price to break above this, retest it, move higher, and then we would look to take out these highs. All right. Collie, never heard that way to play inside bars. Awesome. Yeah, really, really glad you're enjoying the content, guys. So for me, I'm very much a range-based trader. So I like playing level to level. And this is a really, really good pattern. However, you don't always have to wait just for the inside bars. Okay. And just to finish off on this point, if we don't get that move, so if we don't get that move higher, then what we're saying is, are we getting a rejection here? In which cases we can see prices come into here. We would want to see it come back below, take the liquidity, and then head lower. And in terms of targets, once again, I'd be looking for these lows or the last down candle before the move up. So, okay, yeah, good question here. What time frame, like on the 4 hour? So you can absolutely play these on any time frames that you want, right? The key thing is that what we need to establish is our execution-based time frame, all right? So if we take this inside bar example here, we've tagged this on a daily. So we would want to be executing probably an hourly or maybe even sort of a 15-minute time frame. Now, what we can see here, we've got this represents simple support and resistance. This is our range, right? So if we take our Fibonacci's and then we take the 50% line, which is this one, we draw this across. This then becomes our range, okay? And now, like with any range-based trading, we're waiting for one of two situations to happen, right? We're waiting for price to break the high and then either deviate, close back below, in which case we target lower prices, or retest and then start to move higher. All right? So if we want to execute on a lower time frame, like a 15-minute, that's when we can really start to get into our market structure. Now, market structure for me is hugely important, and I do really think it's something that can be easily overlooked. And, you know, in my opinion, it really shouldn't be because it's such an important factor of trading. Now, if we look here on a 15-minute chart, what we can see is as price breaks out, we're making higher highs and higher lows. What we're interested in is when price is coming back down to this key area here, because we want to see if it's coming back to take the liquidity before it moves higher. Quite often, what you'll see is for breakout traders, is if breakout traders are going long here, what often happens is price comes back down, takes stop losses, grabs the liquidity here before fueling a move higher. So we want to try and make sure that we're on the right side of those moves rather than getting caught on the wrong side. So by using simple market structure, what we can say to ourselves is we can either play that as a breakout play, right? Or if we're using it more under scalping methodology, which is how I like to play it, I just need to know where the liquidity sat. So here we can see we've got a clear uptrend. Yeah, we've got higher highs, higher lows. Now, when price breaks market structure to the downside, what we're saying to ourselves is this is the last up candle before price made the move down. So this immediately becomes of interest. And what we're saying to ourselves is we expect there to be liquidity here, or we expect some kind of reaction. Once again, as with any support resistance level, right, any order block, we're simply waiting to see if price gets above, as we can see it does here, right? Retest, move higher, yeah? And then from that point, we can take a look at this level here and we can say to ourselves, right, a break of this level, the market has accepted this, it's turned this from resistance to support, yeah? So from supply to demand, and then we're saying the high probability trade is to the upside. Now, I will cover this on lower time frames and that as well, guys, and show you, because with price being fractal, how we can break this down onto even lower time frames. And if you wanted to really scalp into this on a 1 minute, you can even do that. But for now, let's take this. We've got our daily range. We're down on the 15 minute. We're looking for our market structure break. And we've got a nice clean target, right? Now, often I will favor the highs of these moves. So we've got our order block here, but the highs are often where your stop losses are sat. Now, people that went short here will typically have their stop losses up above this high. They'll wait for the breakdown, stop losses up here. So we need to remember that when we open a short position, yeah, a sell order, our stop loss becomes a buy order, right? So when price comes back up into these levels, yeah, it's taking out those stop losses. It's also triggering breakout traders, yeah, who want to trade to the upside. And then what we can see is where we don't get the close and we don't get the retest, price breaks back below, retests that liquidity here and here, and then starts to sell off, okay? So let me just clean this up a second, and then we're going to break down how we would play this. So we've got our theory on our high time frame, right? We've got our daily levels, which we've got from our inside bar. Now we're saying to ourselves, we break out from this move. To confirm this isn't a deviation, we want to see this retested. When we get back to the area of the retest, yeah, then what we can see here is if, again, by our principles, we're saying the liquidity is in these points of consolidation. Now, while this didn't break market structure, yeah, which is what makes our order blocks more valid, is we're looking for the ones that break market structure, we are saying that there's liquidity here. So let me zoom in. So this down candle here, before this move up, this impulsive move up, yeah, we can see the gap that it's left here, this inefficiency. So what we're saying to ourselves is if price comes back down into this area, we're going to be conscious of this line here, which is the top line of our mother bar, but we also want to look and see where the liquidity is sat. So once again, if we mark out our down candle here, we want to see what happens when price comes into this, and we can see how it wicks into this. The long wicks to the downside are telling us a story, the same way as these long wicks to the upside are. This is showing us that price has tried to get up here, but has been rejected hard, meaning that there's a lot of sell pressure. And this is the same here. Price has come down here, found liquidity. Now, the long wicks to the upside here are showing us that there's buy pressure. So, if we were doing this in a simple form of market structure, we would say on a micro level, we've got our high, low, higher high, higher low. So if we want to play this as a breakout trader, we'd be looking to play a breakout above this level here, all right? So we're saying price breaks out here. When it closes, we can open our long position. Our stops go under the prior swing, which is here, and we know where our target is, all right? So our conservative target would be the low end of this order block. Yeah, and our target above would be here. Now, for me personally, how I trade, I wait until I get to target one or a preset level. Then I'm looking to flip my stop loss to entry, right? So that once I've taken a little bit off the trade, then as it continues up, the trade is risk-free. If we get a huge rejection to the downside, or a fundamental event comes in and just totally trashes the market, we've secured a little bit of profit and we move on to our next opportunity. But I like to de-risk quite quickly. So that's how we could play that, right? Now, if we were looking for scalping opportunities and we could say to ourselves, okay, well, here on a more macro sense, we've got the high, low, then we set this higher high, yeah, and the higher low. Well, we can take the same principles of liquidity here as well, right? What we're looking for is we're looking for the last down candle before price broke out as we have done with our order blocks, we can take the last down candle here. Now, it's important to remember that we've set this down candle here as soon as we break up above it. And then we would simply layer our orders in. And these would be limit orders, okay? And what we can see here is I've just got a simple Fibonacci that's got 1 and 0, obviously, but then 0.75, 0.5, and 0.25, making it a range. I would layer orders in down here, all right? 20%, 20, 20, 20. Or you could, for example, break it up a little bit less than that, and you could say put 50% of your order at 1, 50% at 0.5. So you've got the nice pullback. You see the liquidity being set here. We've got our market structure break on a macro level because we've broken this high. We're then saying we've got bullish momentum because we've got confluence and confirmation from our higher time frame. We've also know that we've got the reaction here, and we know where we target. Now, the good thing about this method is our orders are layered in all the way down here, right? So when we take our long position, our average entry would be somewhere like here. And our stop loss, because we've run the liquidity, guys, right? That's why we can be so aggressive with our stop loss placement here. This is much more of a scalping method, where this one here was more of a swing method. But all we're doing, we know where our target is. We know that if our theory is correct and this has taken liquidity, then it shouldn't break below this low, right? Because then it would be invalidated, and then you can just cut the trade. As price comes in here, we get the move to the upside. And something else that I love in terms of candlestick patterns, I love seeing engulfing candles like this one here, right? It shows you that the momentum's with you. It shows you that the market is moving in the way that you would like it to move. And the same way with inside bars, which I'll go into shortly as well and show you how we would play an inside bar breakout, right? In comparison to how, in this instance, when we zoom back out to our daily chart, we're using the inside bar much more as a pattern, right? The inside bar here is making our range, yeah? Now, when we're playing this as a range based on a higher time frame, we're either waiting for the deviation above, close below, trade lower, or for price to close above, retest, and then trade higher, all right? However, if we're looking to play for a breakout trade using an inside bar, what we would look to do is we would wait for the inside bar pattern. Let me see if we can find one here to show you guys. So see here, this makes up our mother bar. And what we're saying here is our theory is that if we have the inside bar is a bullish candle followed by a secondary bullish candle, yeah, then that's our entry to go long, and our stops go under the mother bar. All right. So let's have a look. Got a couple of questions in the chat. One here from Sheila. Hey, Sheila. So is it better and safer to get in on the retest? Yeah, so for me personally, I like to see retests because it shows me that it's not a deviation. Now, if we use this inside bar here as an example, yeah, which we've just taken on an hourly chart, but again, we can see how the situation is the same, right? We're waiting for price to either break out, hold, and then move higher, right? Or for it to be a deviation, close below, yeah, and then trade below that low. In this instance, we got a little bit of both. If we take our range here, here's our mid-range. We can see price broke above, deviated, closed below, and then traded to the 50% line. In this instance, we'd be trading this. Let me just do a replay so we don't spend forever looking for the chart. On a time frame this low, you would be playing this on the minute-based charts, all right? So what we can see here is we come up and we have this deviation. We don't get the clean retest. Price breaks back down into here, right? And it's the same with this. We then come down, price breaks out here, but notice how we've only got these bearish candles coming in. Then as we close below, we would take a trade with our first target being the midline and the second target being the range low. In this particular instance, price comes down, reaches the 50% line, in which case we would have moved our stops to entry and taken, say, 30% off the trade before price reversed and took out our stops. Now, if I just zoom in on this a bit for you and give you a cleaner example, make sure that's spot on as well. So, as price comes up here, we don't get the retest of this level. We don't get our bullish confirmation candle. What we do get here, as we can see, and I hope you guys can see that cleanly, we get this close below, right? So as we get the close below and we're back now within the range, what we're saying is that this move here is a deviation or a fake out. Price isn't ready to go higher, yeah? And then we can see as price comes in, we then trade down to the 50% level. Now, like any trading system, guys, none of this is foolproof, okay? You'll get winners, you'll get losers, and obviously the lower time frames you're breaking down to, the more chop that you're likely to get. But under similar principles, if we're looking at market structure again, as we did previously, if we're saying to ourselves when we get this breakout, yeah, price breaks out from here, we don't quite get the retest. However, what we can see is price gets up here and is now starting to drop back where it's looking for liquidity, right? We haven't got the parabolic move up. Price has broken this higher, but it's started to falter, all right? If it's going to come back down here and look for liquidity, then we can trade that when it gets back to our key level, all right? So for me, the breakout and the retest just gives us a little bit of extra safety in there as well, all right? Because we're looking for what price has done. Breakout traders can often get trapped on the wrong side of moves, yeah? So for that, we want to make sure we get the retest. Now, obviously, the higher the time frame, let me just clean this up. Higher the time frame that we're trading on, then there's a slight difference here, right? Because we can see here this candle coming back into our area of interest. That would count as a retest. If we're then doing this on an hourly chart, yeah, we would want to see this. We would want to see more of a market structure retest, all right, made up of multiple candles. So we're using our higher time frame to set our bias, right? And then we're executing using a lower time frame. So I hope that makes sense. If not, please do pop something in the chat and I will try and explain it a little bit clearer, all right? Just pouring myself out a cup of tea, very British of me. So here we go. Vinny, love the simplicity. Awesome, bud. That's great. Thank you very much. It is, I do like to try and keep things simple, as trading can be complicated enough, right? Now, a question here from Jax. Can you please explain the engulfing candles? Yes, certainly, bud. So let me close that off here. So on any time frame at all that we want to trade, let's just, as an example, let's keep ourselves on the hourly, right? Here we go. So we're always looking for our market structure, yeah? Now, even if we're looking on this level here, we can see that there's some real confluence around this level. So for me, immediately, even with no other lines on the chart, I'm saying I can see that this has acted as resistance here, yeah? So very, very roughly, without even going to any higher time frames, we're looking at this, we're saying resistance, resistance, flip to support. Support, support, in and around this area. As we lose this level, we come down and retest it, and our confirmation, or one part of our confirmation, that price is ready to go lower is this engulfing candle here, all right? Now, an engulfing candle, or certainly the way that I use an engulfing candle, is I'm looking for body to body, right? Now, what we notice here is this body has completely engulfed, completely consumed the previous one, right? That then leads to show us that there's a lot of bearish momentum here. And what we've got is we've got confluence from our level. We can see where the support and resistance is. We can see as we lose this level here, we come and retest it. We retest it here, here, and here. And then we finally get our bearish engulfing candle here that would become our trigger. And then we would look to trade price lower. Now, whenever we're looking for targets, what we're looking for, or what I look for, is I'm looking for lows that haven't been run, So if we're taking into account our order block theory here, right, and we're waiting for a break in market structure, So we come down here, we've got our low, higher high, higher low, yeah? This is the last down candle before price makes its impulse move up. I'm interested in this here. I'm going to draw this across. And now I've got my targets, right? So always remember to look left on your charts, guys, all right? Always remember to look left. Quick question, too. Simon EQ. Yeah, absolutely, bud. You're right. I didn't want to use that one as an example. So Simon's just said, which is absolutely correct. This candle here is also an engulfing candle. So, which is 100% correct. Because you look at the bodies here, that is engulfed, even though we've got the long wick to the upside. I was just using this one as an example because it's very, very clean when we're looking body to body. The good thing about this candle, though, is the fact that it's an engulfing candle and it's also a pin bar, which is also a reversal candle as well. So that's a really, really good spot, Simon. What you've got is this long wick to the upside, showing that we've got sell pressure that leads to a body here. So that could be your entry here, or this one, a larger engulfing candle. And we can notice as well that when we get to the lows here, yeah, and this is something I always encourage everyone, go and look at your charts and make sure you're comfortable with these bits and pieces, all right? But as we see here, as price comes into this key area, our order block, we're expecting a reversal in price. Then we can see here we've got an engulfing candle here. As price dives a little deeper down in here, we've got another engulfing candle here. And what would be a really nice entry for this one, because we get price dive into liquidity, come above, and then come back to retest it, we get this engulfing candle here, which again is nice confluence to trade this higher. One other thing I'd just like to say in terms of selecting targets, so going back to our entry that was back here, I'm also aware of lows that haven't been run as well, right? So we can see here, we come up, set this low, price hasn't retested it, right? So we want to be conscious of that. And we can actually see here, this is the first point at which price starts to get held up before it moves lower, yeah? And then again, we've got a clean low under there. So always remember to look left on your charts, guys, because this as well does tell us a story. The faster the move and the thinner the move up, the likelihood is you get a very fast and thin move back down as well, all right? So here we go. A couple more questions come in. Two bullish engulfing candles, but continuation after a non-engulfing. So do you mean this one here, Simon? Sorry, mate. Because we've got our engulfing, we come down, or were we talking about the move down here? Obviously, with these, we're keeping this really simple at the moment. You would always look to make sure that you've got confluence on here as well. Okay, 29th of July. So these ones here, yeah. So we've got, was this the one, bud? Or, okay, 29th. So here, yeah, exactly. We've got this. Ideally, what you'd want to do in a situation like this is you'd want to wait for the second engulfing here, because you would say you've set this low here, high. This is a higher low above that wick. And then what you've got on your side is you've got the market structure on your side as well. You've got the engulfing candle here, and then you can look to trade that to the upside. All right. So I hope that's clear, guys. If that is confusing in any ways, I do apologize, but just let me know what it is and I can try and explain it a little bit clearer. So quick question here from Vinny as well. When setting the liquidity areas, do you include the body and the shadows? Yeah. So if I'm using this as a single candle method, then my interest here is always in the body and the wicks. Yeah. So that's how I do it. There's some other people that use order block theory and bits and pieces slightly differently. Some people won't, even consider an order block valid unless it's one that breaks market structure. Okay, so in which case this one would be valid, as would one of these at the highs. So as we see here, we've got higher highs, higher lows. When we set this higher, yeah, set the low, lower high, lower low here, we're then interested in the last up candle before price moves back down. So in this case, we'd be taking this and we go across here. Now, it's also worth noting that people use in terms of market structure, when you're looking back on charts, I use these to trade these live, right? So I'm placing my order blocks where I've got a market structure break. Now, if we were looking at these, and you'll see a lot of people trade this way, which is completely and utterly valid, right? It's not for me to argue with those people. This is just my methodology. This is how I trade. I'm waiting for a break in market structure to confirm to me that we've got momentum to the downside. Then I'm looking for price to pull back into that order block. What you'll see used a lot more, right, is that people are using the order blocks on the extremes, yeah? And the ones that break market structure. So here, because if we were looking at this chart, and this is all the information we had, we wouldn't know at this point that that was the high, right? The last up candle before the move down. Yeah, we'd have to wait for the market structure break, which for me, fine, we've got our lower low, but we don't have our lower high here, yeah? And then you can see if you'd taken that as the order block, it would have invalidated because it broke above. However, if we're looking at prior price action, yeah, so historical price action, then you would say to yourself, okay, you would mark the order block here for the move up, and then you would look to target that down the line. However, if we'd used that method here, the more traditional method, what we would have found is price wouldn't have come into our order block down here. That's because in the years that I've been trading, I've found it a lot more reliable to take the order block that's on the market structure break. But as I would say with any kind of technique or anything, then definitely go away, try this yourself, and by all means, come and grab me in the chat. If you've got a difference in theory, if you've got something else that you're thinking about, then come and grab me. I love to chat about this kind of stuff. And obviously, and this is a very British saying, there are many ways to skin a cat. Ridiculous saying, I don't know why it is, but basically it means that there's a number of different ways to achieve the same thing, all right? It doesn't mean that one's right, wrong, one's better, one's not. All that tells us that is testing this, building our own systems and strategies, and then testing them over time. Resume, buddy. Thanks so much for joining the stream. Good to see you on here, man. Good to see you. So, thank you, Simon. Great questions. Really appreciate that. And then a couple more on here. Blopey, is it? Apologies if I'm pronouncing that wrong, obviously by a hideously naive British accent. But thanks so much. First time I've been here. Where have I been already? Learned so much. Awesome. That's what we absolutely love here at the Nest. And one from Klaus, can you please check BAT and confirm if it's bouncing from an order block? Absolutely. Guys, if you've got any requests while we're on here, have a little bit of fun with it. I know I'm taking up Burb's normal space. He's got some really important stuff he's taking care of at the moment. So I said I'd jump on here and cover his stream today. Obviously, very big shoes to fill, but I hope it's not too dull for you guys. But if you have any requests or bits and pieces or anything that I'm talking about, just want to give you a little bit of an overview. I know it's not what was promised in the write-up, but unfortunately I hadn't checked with Julian. He's got some prior engagement, so he's going to hopefully try and jump on with us. But if he doesn't, I thought nice way to introduce you to how I trade, how I look at the markets, and then we can take a look at some other charts and any chart requests. So let's have a look on 4 hour and BAT. Right, fine. Let's take a look here. Cool. So to give you guys a little bit of an overview of this, so on a 4 hour chart here, just to answer Klaus's question first of all, now we want to know if this is bouncing from an order block. So yeah, so what you're talking about here is this last down candle before the move up. Yeah. Now, the thing that makes this tricky here is that technically on a macro level, we've got our low, higher high, higher low, higher high, higher low, right? So we're already in a bullish structure. Now, price could pull back to this, but while we're in this kind of formation, I'd probably, being sort of a trending bullish formation is what I mean. So we're setting higher highs and higher lows. Yeah. What I'd be taking note of here is the Fibonacci's. So if we're looking for continuation higher here, and I'll explain to you guys how I use some of the indicators and oscillators as well for confluence. But if we're looking at this here, now there can almost certainly be some liquidity in this down candle, right? But what makes it quite tricky to know is we're more interested in the down candles or where we get a break or a change in market structure, all right? And what we've got here is we don't currently have that market structure break, all right? So there could absolutely be liquidity down here, but we would be looking in terms of something like this area here, right? So see, we've got lower highs, lower lows, we're trading down. Now, this is the last down candle before price moves up, yeah? So we'd be interested if price comes back to this region here. Now, I know obviously in this particular example it doesn't, but that's where we're seeing the liquidity be sat. Then we get ourselves into a trending environment here, right? So we'd either want to break this down onto a lower time frame, yeah, or we would look to jump on board this in terms of it being a bullish trend. Now, something I like to use in a bullish trend are the Fibonacci's, right? So if I was looking at this as a bullish Fibonacci, I'm going to draw this from the low, the prior swing low, to the swing high, all right? I'll change this from my range Fibonacci to my traditional Fibonacci, all right? So traditional levels on here, guys, 0, 0.236, 382, 0.5, so 0.382, 0.5. This is, for anyone that's unfamiliar, is the golden pocket or the golden ratio or the golden zone. That sits between the 0.618 and the 0.66, all right? Now, on here, we can see how price comes in. What we do with the Fibonacci is we're expecting a reaction here or on the 0.5 because it shows us that we've got the strength of trend. Now, some people will just set limit orders here, right, which is absolutely fine. What I like to do is I much prefer to wait for a candle confirmation, yeah? So again, I want to see an engulfing candle or a pin bar candle or something that's telling me that price is ready to move higher. So if we now take the prior example, yeah, if we take this low here, to this high, yeah, what we can see is price comes into here, we get our bullish engulfing candle, we can open our long position targeting the top of the Fibonacci, right? Now, there's different methodology around where you set your stop loss. If I'm scalping this and I expect liquidity to be grabbed, my position's opened here and my stops are under here, all right? I'm playing a quick scalp trade to the top of this range, nice 1.94R, a 4.6 trade. That's really nice. Now, if you're playing this in more of a trending environment, and obviously we're still in a scalping environment, in my opinion, price is still range bound. We're still in a macro downtrend, all right? So any of these pumps, we have to expect them to be short-lived until we regain a bullish market structure on the higher time frames. But traditionally, or certainly the way that I've done it, and certainly the way that I've learned from some really, really good, not just range traders, but Fibonacci traders, is to place the stop loss here in between the 786 and the 1. Now, the reason for that is because you can sometimes get swing failure patterns, right? Which is something like this, where you get a high set, price comes up, wicks above it, takes the liquidity before heading lower, all right? And if you're going to use Fibonacci's, that's a really, really reliable way of getting that set. And what we can see here is even if we were to use this method, we'd have a 1.15R, which, you know, you always really want to aim for sort of a 1.5, you know, to 2. But if you're scalping this, you're confident, you've got the momentum on your side, then, you know, it would make a good scalp. However, anything with a low R rate like that, I would only look to put a minimal position in, maybe like a 0.5 or even as low as like a 0.25% of normal. All right. So does anyone have any questions on that in terms of the Fibonacci's? Always happy to dive deeper into that if you've got any questions, guys. One here from Pacific Elevation. Love the name. Would love ETH to come down to $600. Yeah, absolutely. It'd be a great buy around there, wouldn't it? Well, I think so. You know, you never know, do you? But at the same time, when you look at the highs that it reached, it seems if you're applying the right kind of methodology, if you're looking much more from an investment point of view, that seems like really, really interesting one to go for. Jax, great show and TA. Thank you. Awesome, man. Really appreciate the feedback. George, do you ever use the VPVR to set important levels? I do use the VPR sometimes. For me, I'm looking at it a lot more for the volume gaps, right? So let me get rid of a few of these and add in the VPVR for you. So for anyone that doesn't know, this is a volume profile. People use them differently. For me, so I'm using this. Is this the one that you mean, bud? If it's not, then Here we go. So see here, what we can see with the price action that we've got here, and what I like to use this for. So this is our high volume area, our point of control, right? The line that comes out, that's showing us with the information that's on the screen where the majority of trading has taken place. And obviously, as we put more information on the screen, yeah, we get different results. All right. Now, a lot of people will use this as a point to say, okay, price tends to get drawn to it, right? So like a support and resistance level, we can see how when it's lost, it's retested and we sell off. We get above, battle with it a little bit, break above, hold, and then we start to move higher. For me, what I'm interested in are like these gaps, yeah? Where it shows us that there's low volume, because typically, as we can see here, when we break into these levels, then it can represent a quite good target down here, right? And again, if we're using our order block theory and we're saying the last down candle before the move up, or in this case, the down candle as I use it, right, which is the one that's broken market structure, you see how that lines up with the higher volume, showing us that there's a bit of support there, where this area's got a kind of large gap in it, right? So what we're saying is if we break below this, we fail to hold above here, if we drop into here, then the chances are on this theory that we can see a slightly faster move to the downside. All right, so that's something that we'd be conscious of. So I hope that's answered your question, bud. Now let's have a look. Klaus, thank you for the feedback, buddy. Really appreciate that. What have we got here? Take a couple more questions. Peace Sniper, what's the difference between the trend-based fibs and normal fibs? So do you mean in terms of... So you've got this, which is our Fibonacci retracement, yeah? And the other type of Fibonacci's that we've got on here are our trend-based fib extensions, yeah? So let me show you how they work. Now, what we're doing here is we're taking key lows and highs and we're trying to estimate where price is going to go, right? So if we haven't got a clear target, yeah, and what we can see if we zoom out here is we would be targeting the liquidity up here, which we didn't quite reach. Let me just turn the VPVR off quickly. So if we don't have a clear target in mind, or we want a little bit of extra confluence, then we can use our Fibonacci extensions, right? So as we go here, what we're doing as we're taking an upside target, because say our entry's around here, we're looking to mark this low, the swing low. You don't have to put it directly on the candle, just as long as the line is directly on it. Then we're going to draw it up to the next swing high, and then we take it down to this low, right? And let me just tidy this up and get rid of these other fibs quickly so that we can have this nice and clean. Now, what we're saying to ourselves here is there's an expectation that price comes up to the 1.618 level, all right? That would be our target here. So we've taken the low to the higher low, and now we're targeting the 1.618. So, and obviously if we're doing it down the other way, then we simply take it in the other direction. We would take it from this high to this low, yeah? And then we would draw it up to this high. So high to low to high. Our first target is the 1.618. Our second target is the 2.618, all right? And actually what you can see quite cleanly with this is as price gets here, it almost treats it like a support and resistance level. Finds a little bit of support here, breaks below, retests it and sells off. And here you can see it almost perfectly kind of holds price up. This isn't something that I use a lot, all right? But obviously it's something, again, that I would always recommend you guys go away, try, see how you get on with it, all right? But for me, with that, you're targeting the 1.618 and then the 2.618, all right, as an extended target. Peace Sniper, you are very much more than welcome. Fernando, why not the fib level on the last down candles? So, again, in terms of where Fibonacci's are technically, I have always taken it from the highs or the lows to the highs. Yeah. So what you're saying is you would take it from the last down candle and then take it to the up candle as well. I've definitely seen some people use that. For me, I've always seen it's kind of traditionally done. The way that I've always used it is taking it from the extremes. Yeah. So the very low to the very high, and then we're looking for price to react here. If we were doing it in this situation, for example, we take our low to our high here, right? And then this is why we're saying sometimes it pays to kind of layer the bids in, or if you get the reaction here, as I often do, you're waiting for that confirmation candle, all right? And in this particular instance, if we were doing that, we can see that price has held here. Yeah, we've got our high, we've now got our low, we've now got a higher high, yeah? And we can see that we've printed an inside bar pattern, right? Here's the inside bar. And remember, guys, why is it an inside bar? Because this candle here is the range, and this candle here trades inside it. So it's inside of this bar. Now, for the breakout methodology of this that we just touched upon earlier, we're looking for 2 bullish candles in a row. Here's our mother bar. The inside bar is bullish candle number 1. This one then becomes bullish candle number 2. And for anyone that hasn't, please go and check out On-Chain Labs stuff. He is absolutely sick at trading these styles of patterns. And then all we're doing is we're taking our long position on the close of this candle, right? We can put our stop loss underneath the inside bar. And the reason we can get away with such an aggressive stop loss is, again, because we're playing this on the base of liquidity. We're saying the liquidity's already been taken here. So our expectation of price coming back down here is low. So we play it up. But if you want it to be more risk averse, you can simply set it underneath the prior swing. Now, in terms of targets, my first target would be up here, right? So I'm looking for these highs to be run, or the last up candle before the larger move down. And again, I'm taking a nice amount of profit here, and then I'm waiting to see, does price hold this liquidity and push up higher, which it looks like it might do here. Or if we break down below, then I'll look to cut the trade. All right. So I hope that made sense, Fernando. Again, apologies if it didn't, mate. Do feel free to pop it back in there. Bella, Stochastic RSI. Yeah, I love the Stochastic RSI. But God, it can be a really, really, really tricky indicator, right? So now what I really like to do if I'm trading with the Stochastic RSI, and let me just add this into our chart. So here I've got my RSI, and here is the stochastic, right? Now, for me, it's very, very important that I'm using it in the right context. So if I want to use this, then I'm using this based on its momentum. So what you'll notice here is we've got the traditional lines are set at 80 and 20. Yeah. So what we're looking for is we're looking for bearish crosses, right? That's when the black line goes below the grey line. Let me zoom in so you guys can see this clearly. So on a 4-hour chart, these are the bits that interest us, right? So we've got our cross there, and let's just to keep it really clean, we'll take the one before it as well. All right, I'll give you guys a quick example. So this is here on our chart. Now I'm going to pop this on replay mode because we're going to move to a lower time frame, and what we don't want to do is end up searching away for that. So on this basis, and another thing that I like to use here as well is the RSI. So if we're getting up into overbought or oversold territory, yeah, it gives you a nice trigger. So when we're here, and we can see this is the box that we marked on the 4-hour, and this is the box here. So we're expecting this to produce bullish momentum and this to produce bearish momentum, right? So this is when the lines cross, the black line's trending up. Then when this line, the silver line, gets on top of here, the black line crosses underneath and trending down, we're expecting bearish momentum. So let's make that in red. And we'll make this in green. Now what we're going to do, we're going to move to a lower time frame. right? And what we're saying to ourselves is as we get this here, we know this is where our bullish cross is coming in. Now on a 4 hour, we're expecting momentum to shift to the upside. So we can sit here. Let me know if this is too small for you guys to see as well, all right? So we can see here, we've now got confluence on the 1 hour that we've had this cross and now price is trending up. It's broken above this and is now moving up, all right? What we can see here is we've got confluence from this on the hourly as well because we've got price trending down. We've got our bearish cross here. And again, we're now back within this middle range. So what do we do to trade these? Yeah, we would literally just be looking for market structure breaks. All right, guys? So we would say onto here, for example, we've got our stock down here. I want to be looking for divergences as well to see if they're coming on. Okay, so as you can see, we get the divergence up here, which is a great counter warning as well that lines up with this. We don't get a bullish one down here, but not a problem because we default to our price action and our market structure. And what we can see here, once we've got the confluence, we get a little bit of divergence here. We can then just look for market structure. All right. Now, as we did before, and we're in this area, we can wait for our high, higher low, higher high, right? Now, what are we looking for again here, yeah? This is our break of market. This is the move that breaks market structure. This is the last down candle that precedes that move. So again, with liquidity, which is on our mind, we're marking this out. We then move to our Fibonacci's. And you don't have to use fibs for this, guys. If you are using fibs for it, then I obviously use a range fib so that you can layer your orders in. But you could just put an order on the top level here, or some people put an order on the 0.5. Now, I like to layer them in because sometimes you're not always overly sure how deep a pullback you're going to get, all right? But the principle is the same. We've taken confluence from a higher time frame, which has told us that we've got bullish momentum building. We wait for our market structure break, but we don't want to get in up here because our risk to reward is just not very good, right? So we want to go up, wait for the move that breaks market structure. Then we've marked our last down candle. We've placed our limit orders in here. Yeah. So let's say our average entry is here. Our stop loss goes under the prior swing low. And again, we're looking left on our charts. We're saying to ourselves, this would be a viable target for sure. I'm just going to mark these just with a ray. All right. Just so I can get through it a bit quicker for you guys. This would then be another target because again, these highs haven't been swept. And then if we were looking further back on the chart, we would then ascertain targets from further back as to where this can run. All right. And again, if there's nothing overly clear, this is a time when the trend-based fib extension can come in quite handy. Yeah. So remember what we did before? We take it from this low to this high, back down to this low. And what we can see is that 1.618 was tagged really nicely. Now our extended target is 2.618. But the methodology that I use, as soon as we've entered down here, when we reach target 1, or sometimes less than that, I might target a specific amount of R, risk to reward. Then I'm moving my stop loss to entry. I'm taking profit quite heavily at target 1, and then I'm happy to let it run. And as we progress up, I'll just keep moving my stop loss up, all right, underneath the prior swings. So it would go underneath this one now, we're above target 2. And if price drops back down, it takes out our stop loss in a nice amount of profit and we can move on to the next trade. All right, guys. So I hope that's nice and clear. Do let me know if you'd like me to go over anything else in regards to that. And Fernando, okay, thanks. I asked because of how you put the first fib on bat. Okay, mate. Apologies. Maybe I was rushing. But yeah, I'd always use the extremes from the lows to the highs for Fibonacci. But again, if I made a mistake there, I do apologize. Tommy, thank you very much for the positive feedback as well. Peace Sniper, George, brilliant. Really, really enjoyed coming on for you guys today. It's been really lovely having access to you guys. I know, Bird's some really, really big shoes to fill. real pleasure for me to be able to kind of come and step in. Hopefully it showed you guys something a little bit different. Something else I'd like to share with you guys before I go is just about my more of my high time frame bias and what I'm using as counter indicators as well with the market. So let me explain what I mean by that. So if we go here, right, and let's just take a quick look at Bitcoin. Now, with Bitcoin, what we can see quite clearly here, we've got this nice uptrend. Forgive my squiggles and bits and pieces because this is my live trading chart. Again, you can see here for real exactly how this has been playing out in trades that we've taken. Here's our inside bar. Yeah, from a higher time frame. We get the deviation below here, come and close above, take the liquidity from the market structure break and trade higher. Here's another inside bar. All right, from a higher time frame. This represents the inside bar. What happens? Price comes down, takes the liquidity, trades higher. All right. And we actually broke out of the top of this inside bar here. And then if we look at the last down candle, I was funny enough just talking with Razun earlier about this, how just missed entry on this long. Price didn't quite retrace into it again. So as always, guys, these systems are never completely foolproof. All right. But I digress. But forgive the noise on the chart, right? What I just want to show you is more about how this price is moving. Yeah. So let me hide all of this. Now, what we can see here is we've got this nice uptrend. Yeah. So price kind of had this fake out here, this deviation above this high, closed below. But from here, we've just been making higher highs, higher lows. All right. A little blip in here, but nothing significant. We've had this bullish momentum. So let's just mark this area here with a vertical line. Yeah. And of course, that's obviously brought all my other drawings in. Silly me. But let's mark this with a vertical line because I want you guys to see what I'm going to discuss next. So this is on the 3rd of July. All right. 3rd of July at 1600. This is when we really started to get this bullish move. Now, I like using the DXY, which is the dollar index, which maps the strength of the dollar against other assets, as a counter indicator for Bitcoin. It's never 100%, but it's been very, very reliable, as has Bitcoin's correlation to ES, which is the S&P 500, but on the mini contracts, which I'll show you as well. So we've marked this line on here, which is on the 3rd of July at 1600, and we've had bullish pressure. Yeah, so we've had an up move. Now, what we would expect to see, right? Check that date again because I've already forgotten it. Was it 1600? 3rd at 1600. All right, 3rd of July here. And we can see, I know that's tiny, but we can see here how as we have this pullback here on the dollar, so as the dollar's showing weakness, it normally means that risk assets are showing strength, right? So here we've got 3rd of July, which opens here because obviously it's closed for weekends, right? That's why you get the 2-day jump. As price is trading lower, this weakness is giving strength to risk assets. And the reason for that is because the DXY is seen as a safe haven, okay? So if the appetite for risk is low, which it is in the current economic climate, then when we see strength in the dollar, as we see here, and let me put this on a 4-hour because this is a bit cleaner. When we see strength like this in the dollar, yeah, so where's this? This is the 5th of July, this starts. If we go to the 5th of July here, we see as we get that parabolic move to the upside, we get a significant drop here in Bitcoin, all right? And again, it's never, ever a guarantee, guys, but it's something that you can plug in for your confluence. The other thing that we want to look at, or that I like to look at, is the ES1, right? Now, this is the S&P 500 mini futures. It just means smaller contracts for the S&P 500. And what we can see here is the correlation with Bitcoin, right? So as price is moving up, as we've got at the moment, we get the bullish momentum comes into the market here on the 5th of July. And we can see here on the 5th of July how this almost kind of mirrors it perfectly. And the reason for that is because they are correlated, right? Because they're both representative of risk assets, okay? So just to show you something that you guys can look at as well when you're considering trades. So for example, if you go on to something like ES and you draw out your support resistance levels, yeah? Now you see this green line down here, which is a key support. We can see as we came into it here, reclaimed it, retested, moved higher. It's held price along here. As price is moving up, that makes me interested more in Bitcoin and alts, because if we get this here, as we do, price comes in, takes the liquidity and trades higher, then I'm expecting to see some strength. And by this being at support is giving me a little bit more confidence to go and put an investment or open a trade on Bitcoin or alts. All right, guys. So thanks very much for joining the stream today. I know it's been a little bit of a long one, just a little introduction to me. We'll get Julian on another time. Unfortunately, he's not been able to get away. He did message to apologise, but it's not his fault. I was just hoping to grab him onto the stream. We can take a look at Atom, but actually it's been really nice for me to kind of get introduced to you guys, show you my kind of methodology around trading. If any of you want to come and grab me in the chat, I'm live twice a week on Monday and on Wednesday. I do have a Twitter. It's BC Richfield. So you can look for me on there. It's the dinosaur logo. Triceratops, for anybody that's maybe of my kind of age, might remember a Disney program called The Dinosaurs. He was a character from that. So, yeah, it'd be great for you guys to stop by. I am live at 1100 UTC on Wednesdays and on Mondays. But come and grab me around the chat, in the chat, the Nest Club chat, or drop me a message on Twitter. Come and say hi. Be more than happy to go over this stuff with you again. And also as well, if you guys have any suggestions, I make a weekly video that goes onto the Bird Nest trading channel. It's called Trading School. Now, it covers these things in quite basic detail, but if you guys have anything that you're thinking of, anything that you're wondering about, or anything that you'd like kind of a bit more of an explanation on, or even if it's something that you're curious about, drop me a message in one of the chats. I can add it in. I'll make a little video for you guys. You can take a look at it, and then we can always open it up on the forum. All of my videos are also available on the Nest Club, so you can watch back through the webinars if you're interested. And yeah, do just stop by, say hi. If you've got any questions, don't hesitate to reach out, all right? But thank you so much for stopping by today. Sheila Bella, P Sniper, Vinny, Fernando, Tommy, George, Klaus as well from earlier. Sorry, I'm just going back through these. Jax, Pacific Evolution, Pacific Elevation, sorry. Razoon, obviously, Blow P Simon. I'm really sorry if I've missed anyone on here, but thank you all for joining, and I really do appreciate it. Do come and say hi around the nest, and I'd love to see you guys on another stream sometime. Have a fantastic weekend, trade safe, and if you've got any questions, don't hesitate to give one of us a shout, all right? Have a fantastic weekend. Thanks very much.